Welcome to FinTalk podcast series. All right, let's jump right into a crucial topic today. We're doing a deep dive into a fundamental financial product, one that's really designed with a powerful, singular purpose, creating a financial safety net for the people you care about most.
That's exactly it. Sometimes I think of this product as building a kind of financial replica of yourself.
A financial replica. How so?
Well, not in some sci-fi way, obviously, but purely from an income perspective. The idea is to set something up that can step in and continue providing the income and support your family relies on, even if you're no longer around to earn it.
And the basic idea behind it is pretty straightforward, isn't it?
It really is.
Yeah.
You commit to paying a regular amount, usually a relatively small fee. That's the premium for a set period of time.
Right, you pay the premium.
Exactly. And the promise from the insurer is if you were to pass away during that specific period you've chosen, they provide, a significant sum of money to your beneficiaries, your family, dependents, whoever you've named.
And significant can mean quite large amounts, right?
Yeah.
We're talking.
Oh, absolutely. Depending on what you set up, it could be 1 crore, 5 crore, even 10 crore or more. Serious sums.
So, okay, this big payout arrives.
Yeah.
But it's not just free money. It has a specific job to do. What's that job, really?
Its main job, its primary mission is income replacement. Simple as that. If your family depends on your earnings to live, this large sum is meant to generate enough cash flow to help them, maintain their lifestyle.
Cover the bills, meet obligations.
Exactly, all of that. It's about providing financial stability when you're not there.
And how reliable is that payout? Because, I mean, that's the whole point, isn't it? Reliability?
Generally, yes, it's very reliable. The payout typically happens upon death. Now, there are a few specific, quite narrow exceptions you should be aware of.
Like what?
Things like suicide within the first year of the policy starting, or if death occurs while someone is actively involved in a criminal act. Those are standard exclusions. There's also an important point about applying. Let's say you unintentionally missed mentioning something minor from your health history years ago. Maybe you just forgot. The insurer generally only has a 3-year window from when the policy starts to contest that.
Only 3 years.
Yes. If they don't uncover that kind of misrepresentation within those first 3 years, they are legally obligated to pay the full amount upon death later on regardless. So there's a strong element of certainty built in after that initial period.
Got it. Okay, so that's the basic concept. Pretty solid.
Yeah.
But then you actually have to make some decisions. And the first one, maybe the biggest one, is how much cover do I really need? That feels like a huge question.
It is huge, but you can break it down. It isn't just plucking a number out of thin air. While it feels abstract, you can make it very concrete by looking at, your family's actual monthly expenses. Start right there.
Just what they spend each month.
Yeah. If your family needs, let's say, 50,000 rupees just for basic living costs right now, your cover needs to be large enough to generate at least that much income. And not just for a year or two, but consistently for many years.
Okay, and you can kind of test that number, right?
You absolutely can. Let's take that 1 crore figure we mentioned earlier. If your family got that 1 crore and invested it very safely, maybe in fixed deposits, let's assume, say, a 6% annual return, just for argument's sake.
Okay, 6% on 1 crore.
That's 6 lakhs per year. Divide that by 12 months, and you get 50,000 rupees a month.
Ah, okay. So 1 crore could, in theory, cover those current 50K expenses if invested conservatively.
It could, for today. But here's the critical part. What about tomorrow? What about 10, 20 years from now?
Inflation.
Exactly. Inflation is the silent value eater. That 50,000 rupees of income generated by the 1 crore might only feel like, 30,000 rupees in terms of what it can actually buy a decade or two down the road.
Right, so the cover needs to account for that erosion.
Precisely. The key insight here is that your cover amount needs to be large enough, not just for today's expenses, but to also provide a buffer against inflation over the long term. Or maybe your family's needs just grow,
Which often means needing more than just the bare minimum calculation suggests.
Absolutely. Maybe a 2 crore cover makes more sense. At 6%, that generates 12 lakhs a year, which is 1 lakh a month. That gives a much bigger cushion, more flexibility, more security to handle rising costs for a much longer time.
And it's not just about the day-to-day living costs, is it? People have bigger financial commitments.
Oh, that's a vital point. You must factor in any outstanding loans, things like a home loan, EMI, car loans, maybe future education costs for kids that you were planning to cover.
All the big stuff.
All of it. The goal isn't just to replace the grocery money, it's for the payout to generate enough income to cover all the family's expenses, service those existing debts, and ideally leave a bit extra as a buffer for unexpected things or future goals. It's about making sure the whole financial structure you've built can keep running smoothly.
Okay, that makes sense. So nail down the number, the how much. Then the next big strategic question is, okay, for how long should this protection last? And this duration, that's something you decide right at the start, correct?
Yes, that's right. The policy duration, the term, it's typically locked in when you buy the policy. You're essentially choosing the time frame during which this financial replica needs to be active and ready.
And the thinking behind choosing that time frame.
The core principle is about providing that income replacement during the years your family is most financially dependent on you.
And that level of dependency, well, it changes over a lifetime, doesn't it?
It absolutely does. When you're younger, maybe you have young children, possibly a spouse who isn't working or hasn't built up significant savings, yet the dependency on your income is very high then.
Makes sense.
But as you get older, hopefully your children become financially independent. Maybe your spouse builds their own retirement savings. And your own personal savings and investments tend to grow over time.
So the reliance specifically on this payout might naturally decrease later in life.
Exactly. While people are living longer, which is great, the period of peak financial dependency often falls within a certain age range. Many people find the sweet spot for policy duration is somewhere between ending at age 60 and age 70.
Why that range?
Well, it aligns pretty well with those typical dependency periods, kids likely grown, maybe mortgage paid off, and also with average life expectancy projections. And here's a really crucial practical point. If you try to extend coverage significantly beyond, say, age 70, the premiums often jump up disproportionately.
It gets much more expensive.
A lot more expensive. You end up paying a very high price for coverage in years where arguably the financial dependency might be much lower or perhaps covered by other assets you've accumulated.
Okay, so you figure out the amount, you figure out the duration, that's the foundation, the core policy. But life isn't always standard, right? Sometimes you need to tweak things. This is where add-ons or riders come in.
Exactly. Riders are like optional extras you can bolt on to the basic policy to tailor the protection. They help you customize it for specific needs, potential risks you're worried about, or expected changes in your life circumstances.
So what's an example? You mentioned the base policy amount is usually fixed.
Right. It's generally quite rigid. So one rider that addresses this is the life stage benefit. It recognizes that your financial responsibilities aren't static.
How does it work?
It basically gives you the option, the flexibility, to increase your cover amount at certain significant life events without having to go through a full new medical checkup each time.
Events like?
Like getting married or having children. These are times when your financial obligations typically take a big leap upwards. This rider lets you bump up your protection to match those new responsibilities. It adds crucial flexibility to a long-term product.
That sounds really useful. Okay, what about situations where you might not be able to pay the premiums anymore? Like something happens to your health or ability to work?
Ah, yes, that's a huge concern. And that brings us to the waiver of premium rider. This one is incredibly important, I think. It's designed for those unforeseen circumstances that could stop you from earning an income and therefore stop you from paying your premiums.
What kind of circumstances trigger it?
The most common ones are suffering a permanent disability that prevents you from working or being diagnosed with a specified critical illness, like cancer, for instance.
And if that happens?
If you have this rider and one of those covered events occurs, the insurance company waives all your future premium payments. But, and this is the key part, your policy continues, the full death cover stays in place.
Wow. So the protection remains even if you can't pay.
Exactly. Imagine losing your income due to a serious illness or disability. The last thing you need is to also lose your life cover because you can't afford the premiums. This rider prevents that. It's a massive relief.
That does sound powerful. You mentioned critical illness there. Let's dig into that rider specifically. How is a critical illness benefit different from just having regular health insurance?
That's a really important distinction. Health insurance is there to pay your hospital bills,
Right.
your treatment costs, the direct medical expenses when you get sick.
Right.
A critical illness, think major things like heart attack, stroke, kidney failure, certain cancers. It's different. Yes, it involves medical costs, but it often also stops you from working for a long time, maybe even permanently.
So it impacts your income.
Precisely. The critical illness rider isn't primarily for paying medical bills. It provides a lump sum cash payout directly to you upon diagnosis of one of the covered critical illnesses.
And what's that lump sum intended for?
It's mainly there to help replace the income you're suddenly losing because you can't work. It gives you financial breathing room during a really tough time. You could use it for living expenses, maybe for treatments health insurance doesn't cover, or even adapting your home if needed.
How much can you get?
It depends on the rider you choose. It could be, say, 10 lakhs, 50 lakhs, maybe even 1 crore. But here's a really crucial nuance, something people often miss. With many policies, this critical illness payout is actually an advance from your main death cover.
An advance, meaning?
Meaning, if you had a 2 crore death cover and a 50 lakh critical illness rider attached, and you claim that 50 lakhs after a diagnosis,
Then your remaining death cover reduces.
exactly. Your remaining death cover for your family would then be 1.5 crore. So it's usually not extra money on top of the death benefit. It's accessing part of that death benefit earlier while you're still alive because of the critical illness. It's paid from the same pot of money.
That is a really important detail to understand.
Yeah.
Okay, what about specific protection against accidents? That's often a big worry.
It is. And for that concern, there's the accidental death benefit rider. You hear the statistics about fatal accidents, unfortunately quite common. So this rider addresses that specific risk.
And what does it do?
It provides an additional lump sum payment to your family if your death is specifically caused by an accident. This payout is typically extra, layered on top of your basic death cover.
So it's genuinely additional money in that case.
Usually, yes. But here's a key pitfall to avoid. Don't think, oh, I'll add this rider so I can reduce my main cover amount. That's not the idea. This is meant as supplementary protection for a specific type of event, not a replacement for ensuring your core income replacement need is fully met by the base policy.
Got it. Supplementary, not substitution. Okay, shifting slightly, there's another rider related to very serious health situations, terminal illness benefit. How does that work?
Yes, this rider applies in, well, the most difficult circumstances. It's for situations where you're diagnosed with a terminal illness and doctors certify you have a very limited life expectancy, often 6 months or less.
And in that scenario?
In that incredibly tough situation, some insurers, if you have this rider, will actually pay out the entire death cover amount to you while you're still alive.
The whole amount, up front. That seems counterintuitive for something called a death benefit. Why?
The rationale is to give you access to those funds when you might need them most regionally, perhaps for experimental treatments not covered by standard insurance, specialized palliative care, or maybe just to get your financial affairs fully in order and ensure your final months are as comfortable and stress-free as possible.
Okay, I can see the logic there.
And here's a rather surprising detail. If you receive this full payout based on that terminal diagnosis, but then maybe due to a new treatment or just beating the odds, you actually live longer than the initially projected time frame.
You don't have to pay it back.
Typically, no. You usually do not have to return the money.
Wow, that is unexpected.
Yeah.
But are there catches? Is it easy to actually claim this?
Well, that's the practical consideration. Getting doctors to definitively certify a terminal illness with such a specific short time frame, like 6 months, in a way that the insurer will accept for the payout. It isn't always straightforward. It might not be as common in practice as the feature sounds on paper. So while it's a compelling idea, the likelihood of actually using it needs some realistic thought.
Right. Okay, let's circle back to that inflation worry we talked about earlier.
Okay.
The fear that the 1 crore or 2 crore you set up today just won't be worth as much in 20 or 30 years. Is there a rider to directly tackle that?
There is indeed. It's often called the increasing cover option. It's designed specifically to address that concern about your cover losing purchasing power over a long policy term due to inflation.
And how does it work? Does the cover just go up?
Pretty much. This rider automatically increases your death cover amount each year by a fixed percentage, maybe 5% or 10%, usually for a set number of years or up to a certain limit. The idea is to help your cover amount roughly keep pace with rising costs over time.
That sounds like the perfect fix for inflation. Why doesn't everyone get this?
Oh, well, it sounds great in theory, but there's a very significant trade-off. The major pitfall here is the cost. This rider comes with substantially higher premiums right from the start.
How much higher?
It can be significantly more, potentially increasing your premium by 50% or even 60% compared to a standard level cover policy where the amount stays the same.
Whoa, that's a big difference.
It is. So while it aims to protect the future value of your cover, it hits your wallet much harder today, every single year. The alternative many people consider is just starting with a higher initial cover amount, maybe that 2 crore instead of 1 crore, anticipating inflation that way, rather than paying those much higher ongoing premiums for the automatic increase feature.
Right, so you pay more upfront for a bigger fixed amount versus paying significantly more ongoing for an amount that grows. Okay, so that's increasing cover. What about the opposite? Is there a scenario where you might want less cover as you get older?
Yes, absolutely. That's the logic behind the decreasing cover option. This rider is based on the idea we discussed earlier that your financial dependency often decreases over time.
As kids leave home, mortgage gets paid down.
Exactly. As your children become self-sufficient, as major debts like a home loan are gradually paid off, and as your own personal savings and investments hopefully grow, your overall need for a massive lump sum death benefit, specifically for income replacement, might lessen.
So with this rider, the cover amount actually goes down over the policy term.
Correct. It reduces incrementally over time, often designed to mirror something like the outstanding balance on a mortgage. And because the insurer's potential payout liability decreases over the years, the premiums for this type of policy are generally lower than for a level cover policy.
Who might choose this?
It can appeal to people who have a very clear, large, and declining financial obligation, like that big mortgage they want to insure is paid off if they die. But there's a caution here, too. Predicting your exact financial situation and your family's needs accurately 20, 30, even 40 years into the future, well, it's incredibly difficult. Life throws curveballs. What seems like a definite decreasing need today might look very different if circumstances change unexpectedly down the road. You might end up underinsured later if you rely too heavily on this.
Okay, so pulling all these pieces together, we started with the basic idea, the financial replica, figuring out that core amount, the how much, and the duration, how long.
Right, that's the essential foundation. And it's not guesswork. It's a strategic calculation based on your family's real expenses, debts, and anticipated future needs.
And then all these riders we've discussed, the life stage, waiver of premium, critical illness, accidental death, terminal illness, increasing cover, decreasing cover, they're essentially tools in a toolkit.
That's a great way to put it. They're tools to fine-tune that foundational protection. You can use them to add specific layers of security for certain risks, like accidents or critical illness. You can build in flexibility for life's changes, or try to address those longer-term challenges like inflation or changing dependency levels.
So it's not just about buying a policy, but building the right policy.
Exactly. The key takeaway for you, the listener, is that understanding these different components, the core policy, the riders, the trade-offs involved, the practical nuances like how critical illness payouts often work, it allows you to move beyond just buying something generic off the shelf.
It empowers you to make informed choices.
Precisely. To tailor this really vital safety net to your specific family situation, your personal risk tolerance, and your vision for their financial security, it's really about building genuine peace of mind, not just about paying a premium each month. So thinking about all these options, especially the ones around duration and adjusting the cover amount over time, dealing with future uncertainty, potential health issues, inflation, here's something to reflect on. How do you personally balance ensuring you have absolutely adequate protection for your family right now, today, with trying to anticipate and plan for needs and costs that are decades away? In that complex equation, what factor feels most important, most critical to you?
Thank you for listening to this FinTalk episode.